Good morning, everybody, and thanks for joining us today. Welcome to Centrepoint Alliance Investor Conference Call. All attendees are now in listen mode only. On the call today, we have Centrepoint Alliance CEO John Shuttleworth and CFO Brendan Glass. I'll pass you across in a moment to John to kick off our discussion to the company's half-year results. Today, we'll have a presentation followed by a Q&A. If you would like to ask a question during the call, please type it into the Q&A panel within the Zoom app. So to kick things off, I will now hand over to Centrepoint Alliance CEO, John Shuttleworth. Go ahead, John.
Thanks, Simon, and good morning, everyone, and welcome to the Centrepoint Alliance half-year results. Thanks for taking the time to join us on the call. We're going to provide an update on the business. We think it will take probably around 20 to 25 minutes to get through. The update today that we're going to run through is going to show a business that has got strong momentum. It's a business that's completed a transformational acquisition, and it's a business that has strong prospects for future growth. And what I'll do in the first part of this presentation, I'll just unpack that for you and help you understand how we're tracking. So the way we're going to run the agenda is effectively, I'm going to go through the business results and then a high-level view of the strategy, and then Brendan is going to take you through some of the more detailed financial results. So let's kick off with the results. So the first half, solid financial performance. We completed a transformational acquisition. We've had cost synergies from integration. And pleasingly, when we look at our performance as a licensee, we're now number 3 in the market, and we'll show you what that looks like on a later slide. Our recurring revenue is 96%, up from 87% in the prior comparative period. Expectedly, some of the investment management margin has been down due to legacy fund outflows and some of the rising costs, and I'm going to dive into the investment management business in a bit more detail. Now, a couple of important points. When we're looking at the numbers we're presenting, there's 2 months of Clearview Advice revenue and expense data in the results because the transaction was completed on 1 November 2021. So a couple of highlight metrics. Gross revenue 95.5, which is up 24.9 or 35% on the prior period or prior comparative period. Earnings before interest, depreciation and amortisation, excluding legacy claims, LTI and one-off costs of 2.5 million, again up slightly at 0.3 million or 14%. We had cash at the end of December at 11.9 million, which was 7% up on the 30 June number, and pleasingly continue to pay a dividend which is ½ a cent, and the ½ cent dividend is strikes the balance between returning some of our profits to shareholders and also ensuring the business has got the capital it needs to invest in some of the growth initiatives that I'll be outlining. So a pleasing first half. We thought it made sense to provide an update on the acquisition of Clearview Financial Advice. So as mentioned, it was completed on 1 November. It's delivered really strong scale and efficiency. We had the organisational structure implemented from day one, and also strengthened the leadership team as we brought the Clearview Financial Advice executives and line managers into the business and rolled out our new organisational structure. We've had strong retention of advisors, and as we'll unpack, we've had some material expense synergies. Now, a few key metrics. Licensed advisors have grown from 315 to 511, which is up 62%. Self-licensed firms, pre-acquisition 151, now 185. That 185 consists of around 700 self-licensed advisors sitting within those self-licensed firms. Pleasingly, our headcount has only had a modest growth from 99 to 105, reflecting the good work we've done on the organisational design and the operating model. The cost to income ratio is starting to come down with the first couple of months of the acquisition, 86 to 82, so 4% down, and the gross profit pre-acquisition to post-acquisition up 14% to 14.1. So We are very pleased with the way the acquisition has gone and the integration that we're doing. What I wanted to do was just run you through now, and we don't have a lot of time, but just talk through our strategy and the focus of the business. And this is a slide I've used before, but I think it's incredibly important to just recap on it. And the industry we operate in is incredibly important, and the need for advice has never been greater. If we start with the size of the business, we've got $13.4 trillion in household assets, $3.4 trillion in super, land and dwellings with people's homes and property, just under $9 trillion, non-super $2.5 trillion, and a massive intergenerational wealth transfer. So the market's big. Now, you then overlay what people are going through. We've got this massive shift from accumulation to retirement driven by the ageing population. And we have a very complex system, which is the interplay of super, retirement, tax, social security. And to navigate that, it's hard to do without advice. The other issue is that there's a reduced number of advisors. Advisors are still continuing to leave the industry, so we have more demand and less advisors. The superannuation pool I've mentioned. And the other issue why people need advice is many Australians are living longer, and the risk of outliving their retirement savings is real. So the thing to remind ourselves is we are in a very attractive industry at the right time. Now, what I wanted to do was talk a bit more about our growth strategy. And the way I thought it made sense to do that was talk through the three key pillars. The first is our licensee and lending solutions business. And that's all about growing scale and expanding the depth of services. And you've seen that through the acquisition we've done, where it's increased our licensed and self-licensed business. We also have a salary planning business. I'm going to talk and call out separately the lending or broking business shortly, because that is a small business that has significant growth opportunities. We have an investment and portfolio solutions business, and that comprises managed funds and managed accounts. We're going to pivot that business from managed funds to managed accounts, and I'll talk you through that. The financial services technology solutions division is an area that is a really key focus for us. We have a strategy around sourcing and integrating cloud-based technology providers to deliver the best digital advice capability, and we're progressively working through what we do with advice tech to improve the advice process, the regulatory tech side, and also the digitisation of advice. Needless to say, if acquisitions emerge that can accelerate the growth, if they're sensible, we will absolutely look at them, whether it's a further acquisition of a licensee, whether it's service providers, it's in the tech space, or it would enhance and accelerate our business to build out the digital advice channels. Now, what I wanted to do was just take you through firstly the licensee, and the headline here is Centrepoint is building scale in the market. This is a ranking, it's ASIC data, it's the ASIC Financial Advisor Register data, and what it is, the period I've chosen is just the end of January 2022, because there was a lot of last minute adjustments made in December due to the FY22 exam, where many of the licensees rolled off advisors that hadn't completed the exams or had left the industry. So pleasingly, you can see we're ranked number 3 at 525 authorised reps, and we're actually the only licensee to show net growth. So we've completed an acquisition as well as had good, strong organic growth. Turning our minds to the self-licensed segment, we have a strong presence, and we believe there's significant opportunity to grow this and improve the yield in this segment. So a little bit about the market. There's around 2,000 self-licensed firms, which comprises about 6,000 authorised reps. So the self-licensed market is around 35% of the total market. When we completed the acquisition, we brought together Centrepoint's AAP business and La Vista. So we now have 185 firms, about 9% market share of firms, and 700 authorised reps. So we've got a strong presence. Many of the small AFSLs, we're seeing those numbers increase because some are seeking greater control of their business, yet they recognise that they operate in a very complex legislative and regulatory environment, and they need assistance, which is the services that we provide. So our strategy going forward is we're going to relaunch the self-licensed business under the LaVista name and continue to develop LaVista as a specialist brand. We're going to recruit new firms to attract to our network and improve the quality of our service offer, and also aim to increase the depth of the relationship with new services. So we see the self-licensed market as a really significant growth opportunity. I wanted to then talk about our lending solutions business, and it's an area that I would describe as a hidden gem that just needs some investments. A little bit of context firstly, if you look at the lending market, the size of the residential lending market is around 480 billion in loans. If you look at the margin made by brokers, and we've just taken that margin across the market, there's a revenue pool of around 3 billion and brokers are writing just under 300 billion. The commercial side is only a little bit smaller than that, 420 billion. Margin slightly lower, but still a $2 to $3 billion revenue pool, and brokers writing around 168 billion. So you've got a lending market where 60% of loans are written by brokers and around 40% direct to bank. There's around 16,000 brokers in the market, and I've listed underneath there some of the big aggregators like AFG, Connective, Loan Market. So when you look at the broader market, if you take a 1% penetration, which is just loans, on an annualised basis, 5 billion in loans is a 30 million revenue pool at the average broker margins, and you can see the commercial numbers underneath. Now, when you, with Centrepoint, this was an area that I was incredibly enthusiastic when I discovered we had this business when I first joined. We have the infrastructure, distribution capability to really grow the lending business. So we actually are a boutique provider of lending services. We've got a credit license, we've got lending infrastructure, we've run the tech, we've got a lending panel, we do all the compliance, audits, training, we provide a community for the advisors. We've got a $3 billion loan book, which is small relative to the market. There's about 80 brokers in the network. We've had good growth, 48% increase on prior comparative period, and the business is profitable with earning 750K. But we're small. We do operate across residential, commercial and equipment finance. We've done an exercise to try to model out, if you take our licensed advisors and our self-licensed advisors, and there's around 1,200 of those, and you assume an average number of clients and look at home ownership and lending, we estimate that there's around $54 billion in loans in our network in a given year. And we know from market intelligence that there's roughly around 20% refinance or new loans each year, which is 11 billion. So if we take the average margins that broking are making with upfront and recurring, there's 65 million in upfront in a given year and around 16 in recurring, which is the total opportunity in our network. So our first strategy is we're going to grow the broking business, and how we're going to do that is we're going to enable advisors to participate in lending. We're going to increase the number of brokers and enable advisors to become accredited to give advice to write loans, and then they in turn can provide their advised clients with a refinancing repricing service on their loan, which is a natural extension of advice. The other area that is not hard for us to do is, with our technology focus, assess the fintech lending opportunity. Building a digital front end on top of our infrastructure and everything we have is not difficult. So whilst the immediate priority will be increasing the number of brokers and providing a service to advisors, we shortly after that will be looking at exploring the fintech opportunity for this broking market. So a really interesting opportunity for the business. The final area that I wanted to touch on before I pass on to Brendan for the financials is really just talking about the asset management side. Now, in our market that we compete in, the platform market has around $990 billion invested on platforms, and the majority of money is on platforms. Some advisors run portfolios off platform, but certainly in the large licensees, most is on platforms. What we've also seen over the last few years is an incredible growth in managed accounts, often referred to as separately managed accounts or managed portfolios. And the forecast by the Institute of Managed Account Professionals is that by 2024, that'll be around 240 billion. Now, for those that don't know, managed accounts are non-unitised managed investment schemes. They're effectively diversified portfolios. They're really efficient for advisors and investors because you've got professional investment managers that are rebalancing the portfolio and taking this issue away from the advisors and professionally managing the portfolios. Again, you look at Centrepoint's network, we conservatively estimate that we're probably across our self-licensed and licensed business have over 40 billion in funds under advice. We have an asset management business, Ventura, that's been around for around 20 years. And we have around 730 million in funds under management. We offer funds as well as managed accounts. We have around 400 million in our Ventura managed account portfolios. So that's a bit of a snapshot of our businesses that exist today. Now, what I did want to say is, whenever we talk about this, it's really important to set the context. We are an open architecture business. We have very strong research capability, which includes anything that we have internally. We have 1,100 products on our approved product list, 10 major platforms, 900 managed funds, 28 SMAs, 9 life insurance providers. So we're open architecture as long as the underlying product or service is a quality one. Our strategy is really around how do we offer the highest quality asset management competitively priced in diversified portfolios. So the key things that we're doing in the asset management space, firstly, we've taken a strategic decision to divest the legacy funds business to Russell Investment Management. Russell are a high quality investment manager. They're the underlying manager of those funds business. To us, they feel like the natural owner of the funds. So we're transferring the investment rights to Russell. We've signed an agreement which we need to complete, but that just gives you an indication where we're heading. The other thing we're going to do is we're going to relaunch our Ventura managed accounts portfolios with refreshed investment options, improved pricing and functionality. And thirdly, due to the demand, and we have a lot of demand for our research portfolios from the research teams, putting those into an SMA structure and working with our partner platforms to distribute those just makes complete sense for our advisors and their clients. So a little snapshot on what we're doing there. So with that, I'm now going to pass on to Brendan. We obviously just touched on some of the areas of the strategy to give you a feel of where we're heading. So now I'll just pass on to our CFO, Brendan Glass, who will take you through some of the detailed financial results.
Thank you, John. Taking a look at the financial results summary, the gross revenue is up by 24.9 million. And that's a testament to the quality of our incumbent advisors, those we've recruited and those that we've welcomed from the Clearview acquisition. Our gross profit is down 9% on PCP with that expected rebate drop-off and investment margin runoff being replaced by annuitised advice fee revenue, which has ultimately driven our recurring revenue to 96%, up from 87% PCP. Our management expenses are down 13% on PCP, or 20% excluding Clearview Advice acquisition. And that's principally driven by 1.2 million in employment expense savings from a complete structural redesign concurrent to the acquisition. And this just demonstrates that cost management has been a consistent focus for the last 12 months. Our cost to income of 82% is evidences that we have really focused on that fixed cost base. And as we increase our scale, that will continue to improve that ratio. Our EBITDA of 2.5 million is up 300,000 on PCP, and that's principally driven by 300,000 in LTI costs in 2020, first half of 2022, and $500,000 in Clearview Advice acquisition transaction costs. Our profit before tax of 900,000 is down 300,000 on PCP, and that's due to the $500,000 in acquisition costs. Now, looking at revenue and expense analysis in a little bit more detail, the rebates are down 1.4, as we mentioned, due to the cessation of platform rebates from 1 January 2021. Our investment margin is down 1.3 million due to higher custody fees and lower margins from the platforms. We've also had cessation of arrangements with BC, IFF and Navigator. This has been offset by Clearview Advice acquisition, or partially offset by the Clearview Advice acquisition, notably for just the 2 months from November to December, with 1.7 in contributed revenue for that period. Now, we needed to take 2 months from the signing of the SPA to completion due to the independent expert report and shareholder approval. So those earnings will continue to improve in the second half. In relation to key expense movements, they're down 2.6 million or 20% on PCP. Professional fees are down 400,000, and this is due to a consistent focus on preventing leakage of cost and also leveraging the strength of our management team without having to focus on external costs. We've had a small reduction in travel, marketing and other costs due to COVID enforced restrictions. Unemployment is down 2 million or 22%. Now, importantly, our headcount is only up 6 to 105.2 after a transformational acquisition of Clearview. And that very small headcount increase validates the delivery of expected labour synergies. The profit will also increase further with scale due to the diligent focus and partnership with Clearview Advice pre and post acquisition. So looking at the balance sheet, our cash of 11.9 million was up 800,000 on June 2021, primarily driven by cash from operations. Our loans receivable reduced by 1.9 with the 1.1, I should say, with the final settlement of NEOS life repayment. And that was partially offset by an increase of $500,000 for a small number of advisor loans, which were taken up with the acquisition of Clearview Advice. Our intangibles increased by 15 million with the Clearview Advice acquisition. And this is comprised of 6.7 million in goodwill, $8 million in identifiable client lists, which pertain to the salary advice planning channel, and 600,000 in trade names. Now, very importantly, our claims provisions have dropped to an historical low of 3 open legacy claims, which compares very favourably to the PCP number of 20, and even more favourably to the 30 at the end of June 2020. Our net assets increased primarily due to $500,000 in net profit generated during the first half of 2022, as well as 13.3 in increased issued capital from the Clearview Advice acquisition, offset somewhat by 2.9 million in dividends paid for the period. Now, looking at the cash movement over the calendar year 2021, cash closed at December 31 at 11.9 million. Our cash from operations was 5.4, which includes $1 million in Clearview funded future leave liabilities for the staff we brought across. We had the final settlement of the Neo life settlement, and we had some recoveries from the RFE loans and other dividend and interest coming through. We also had, as you can see, with the acquisition, a neutral impact from cash, with cash in and out of $3.2 million. We had dividends paid of $8.7 million, being 5.8 for the second half of 2021 and 2.9 for the first half of 2022. We paid out $500,000 in claims, which is a release from our balance sheet, but we had a cash settlement of $500,000 for the period. And we had $900,000 in other finance costs, principally lease payments. Over to you, John.
Thanks, Brendan. And that takes us to the end of the formal part of the presentation. So maybe just to sort of sum up, we feel that we've got a business that has strong momentum. You can see some of the benefits of what we regard as a transformational acquisition starting to flow through in the numbers. And we think we've got a business that's got a really strong core licensee, self-licensed business, but we've got other areas to diversify our revenue growth that I've tried to illustrate just in the brief time we've had together today. So what we might do is we might just open up for and see if there's any questions that Brendan and I would be happy to address. So over to you, Simon.
Thanks, John. Just a reminder that if you would like to ask a question, please enter it into the Q&A panel within Zoom. And we'll just give it a moment. Okay, there's one here from Travis McMahon. If M&A opportunities come up, should we expect further acquisitions to resemble Clearview Advice, or would you look to add something different?
Yeah, look, the way I'd answer that is that, as I sort of indicated in the strategy slide, we're always interested in exploring acquisition opportunities, but there's a few key things that are really important for us. Firstly, if it happens to be a licensee business, acquiring a high quality licensee business is of paramount importance, because you want to make sure that we have a network with really good high quality advisors. It makes no sense to acquire a business and then end up with potential claims or remediation activities, and the Clearview Advice business was absolutely high quality. The other thing we need to look for is a business that is culturally aligned, which was the case when we did the Clearview Advice business, because you can put things together that make sense on paper, but if they're not culturally aligned, and these two businesses were absolutely that, then you're in trouble. But the other issue is that we have to make sure that we, if we're acquiring a business, that we've got the potential for further earnings growth, and we're acquiring more than just a business that makes us slightly larger with more earnings, but we're a larger version of the same. So we're always looking for the 1 + 1 = 3. We in some of the technology spaces, while we're partnering, it's not just restricted to licensees. As we're trying to grow out our business, we look across other areas that could accelerate some of our capabilities, because sometimes trying to build things yourself, you have the build risk, but you also have the execution risk. So if that can speed up some of our plans, we would entertain that. I don't know, Brendan, if you've got anything else to add to that, whether that's...
No, it's very comprehensive. That's exactly what we're about.
Yeah, all right.
Thanks, John. I've just got one more here from Sam. How have Clearview Advice and the Centrepoint Alliance integrated culturally?
Yeah, look, as I sort of alluded in the previous question, the cultural integration has been really good. I guess from the very first start, we engaged in discussions with the executives, and we're working through how we were going to bring the business together. If you hadn't told people and they were observing in the room, it would be hard to have differentiated who were the Clearview Advice employees and who were the Centrepoint Alliance employees. So culturally very good. The people that we really look for in the business that really believe in the advice industry, believe in financial advice, and people with a good service ethic, because we are a professional services company, and I think we've managed to bring the two businesses together. So we're all working out of common offices. They're all integrated in teams working together. And I think it's been one of the highlights of the acquisition has been the strength of that. And a lot of people say that when acquisitions don't work, it's because the human relations or the cultural side is the part that doesn't work. And I think certainly from my observation, we started with a quality business that was very much aligned to ours, so it's worked well.
Yeah, all I'll add to that is that we spent a lot of time working with Clearview Advice, Clearview Group before the acquisition and after the acquisition. So all that preparation was done, and we worked really closely together to deliver that really successful outcome.
Yeah.
I've just had another one come through. Thanks. What do you feel the quality of the loan book is for Centrepoint Lending Solutions? Can you give any statistics? LTV, arrears, non-performing?
I'd probably have to take that under advice, but I don't know if Brendan, if there's anything we can share. But certainly when you look at my understanding of, and when we've looked at the book, it's we've got a small network of quality brokers, but we'd have to take that under advisement and come back on that one.
All right, thanks, guys. There are no further questions at this time. I will now hand back to you, John, for any closing remarks.
No, so look, that's I'd just like to thank everyone for your interest and support with Centrepoint. We'll keep providing updates to the market as things progress, but thanks for just taking half an hour out to hear how we've been tracking in the first half and some of the things we're working on. So with that, I think we can end the call. Thanks, everyone.